I'm really puzzled by Qualcomm stock. You have this company that has hyper growth trading at a mid-teens earnings multiple. There's a lot of companies trading at a mid-teens sales multiple. So mid-teen earnings, they're generating real billion-dollar earnings, posting very strong growth, and yet they also have the defensive aspect of paying a 2% dividend, nearly 2% dividend yield for shareholders. So is this one of these like rare beasts, Qualcomm? And like, what's going on? Is this a mispricing in the market? In all honesty, I'm not sure. It strikes me as really interesting. I want to learn more, and that's part of the reason why I'm making this video. First, let's start with exploring what does Qualcomm do. That's the purpose of this video. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did not own shares in Qualcomm QCOM stock, but I am interested in learning more. So what's their mission? What's Qualcomm's mission? So their mission is to enable a world where everyone and everything is intelligently connected. How does this even translate into a business model? The reality is it translates into a big business model because in the first quarter of 2022 alone, they generated $10 billion plus in revenue. They're growing 30% plus, generating significant earnings per share. And you look at different segments. The business is effectively split between two major segments, QCT and QTL, their licensing segment. QCT is a much bigger revenue portion, but when it comes to profitability, it's about three quarters QCT and 1 quarter about QTL. QTL has much higher margins because it's a licensing business, somewhere between 60, 70, maybe even higher profit margins, whereas you're looking around, 30% profit margins for their QCT segment. Okay, so what does this even mean looking at these two different things? So QCT segment supplies integrated circuits and system software based on 3G through 5G technology, and they're primarily known for their Snapdragon mobile processor that is the #1 choice for Android mobile phones. Historically, Snapdragon also was used with Apple phones. However, they've moved off of them over time. And so QCT, historically, strongly tied to this handset, so effectively the number of mobile phones sold in the world. But they've been diversifying this segment, selling more of their processors into different markets, such as radio frequency front end, automotive, and Internet of Things. And it's not just, little segments that aren't growing. These are really fast growing end markets. You can see how in fiscal 21 they had hyper growth with each of these products. And this continued in the first quarter of 2022, where you're seeing strong growth in handsets. The number, 60% year-over-year growth in revenue from our Snapdragon handsets for chipsets for Android devices, but they're also seeing strong numbers for their RF front end or radio frequency front end technology, automotive, and Internet of Things technologies. And when you're looking at this, to take a step back, the things that they're tapping into that aren't tied to the handset market, so think mobile phones, these segments are expected to grow very significantly over time. You can see how Internet of Things touches so many different types of products and how automotive is expected to really grow at a crazy clip, multiples in the next few years as you have more and more chips in cars. And so that's the QCT segment. Looking at the QTL segment, the QTL, that's their licensing business. So this is where about 90% plus of this is current licensing revenues, where pretty much every major handset original equipment manufacturer licenses to work with them because they have the rights to, let's say, 3G, 4G, 5G technology. So it's effectively this very beautiful model where if you want a phone that's going to be using this sort of connectivity, 5G connectivity, you're going to have to pay a cut, a commission, effectively, a royalty to Qualcomm. Now, this has led to challenges in the past because you might have, let's say, some Chinese manufacturers that say, yeah, it's really cool that you, let's say, invented 3G or was a key player there, but we don't actually want to pay you a royalty. So this is the part that's held me back in the past from getting more excited about them, is because when you have a business model that's fundamentally tied to suing your customers because they don't pay you, that's an uncomfortable position to be in, even if it's sort of a, hey, we helped design this critical technology you're using, you should pay us. So that is sort of the challenging part. But this is also, to consider, this is only 25-30% of their profit comes from their licensing segment, clearly a very important part, and it's a beautiful business model. This is the truth is, this is just an exceptionally beautiful business model. And so when management had their investor day in 2021, they're effectively targeting mid-teens growth with their QCT segment. So that is still strong growth, through fiscal 2024, 30% plus profit margins, looking at growth across, the various different products like handset or the radio frequency front end or Internet of Things. Also effectively expecting their licensing segment to be stable with a consistent profit profile. And so still, given that QCT is expected to grow at a teens rate, you are looking at long-term growth here. And what's amazing is that this is a business, you look at a lot of businesses out there that post, hyper growth but are significantly unprofitable. Qualcomm is a cash cow, nearly $50 billion in capital returned to shareholders over the last 5 years. So think about around $10 billion in capital returned a year. That's more than the actual free cash flow they generated. So clearly, using their balance sheet to pay shareholders. The question is, where does the stock go to from here? Quick plug, if you're interested in finding new investments for both good times and bads, or you'd like to follow along with my personal financial journey, go to unrivaledinvesting.com, where I write a weekly letter. We also have an exclusive community dedicated to learning and trying to find exceptional companies on Discord. Once again, that's unrivaledinvesting.com. Click join the journey. And so as I think about Qualcomm stock, the challenge with them is a couple of things. The first thing that comes to mind is you do have some real customer concentration risk. You have some major manufacturers in the world that are either licensing their technology or paying, to buy their chips. And you have three effective customers slash licensees that together represent 50% of their business. So in any given period, could this create some sort of litigation problem? Could this, result in some sort of challenge? Absolutely. I don't like seeing that level of concentration. Another aspect for investors to consider is that, you should be mindful of the fact that, the vast majority of the revenue effectively comes from Chinese manufacturers. So these Chinese manufacturers are paying licensing fees or buying Snapdragon chips. So you have another layer of concentration. So not only with the customers, but also a significant degree of Chinese businesses. So if you have any concerns about future Chinese-U.S. relations, I'd argue Qualcomm will be one of the stocks that will come under pressure, because once again, you'll be looking at these companies and, will they continue paying, let's say, their licensing fees, their royalty fees, when they say, hey, maybe there's increased geopolitical tension or something like that. So that is something to be mindful of. I know, I've called out Alibaba in the past as one of the stocks I own, and I have a, Chinese investment portfolio. And so here it is, you're getting indirect Chinese risk. So I know some people are uncomfortable about that exposure. So that is something to think about with this sort of defensive growth play, looking at it. And so, it is interesting to consider. Another core aspect to consider is that this business just posted incredible growth in fiscal 2021, and their profit margins jumped. So you saw their revenue jump from $16 billion to $27 billion. You could see the vast majority of that was driven by their handset segment, growing from $10.5 billion to $16.8 billion. A lot of this was based on 5G technology, selling, more chipsets. But their QTL segment also benefited as well, seeing higher profitability. But really, the core jump in profitability was in their chipset business, where you can see their profit margins went from 17% to 29%. That is a huge jump. And they're also, so it's not just last year, but they're also continuing to show strong growth, and they're guiding to continued strong growth, guiding to something like 50% plus earnings per share growth in the second quarter, fiscal 2022. And so you look at all this and you're like, wow, things are great. And based on, look, $145 share price, it sold off a little bit recently, 1.15 billion shares outstanding. This is a $167 billion business. This is a very sizable business. And this is for a company that's growing very quickly, generated $9 billion in profit in 2021, might be closer to 10 to 12 billion in profit for 2022. So you're looking at a company, trading at some mid-teens, maybe even low teens earnings multiple. And so Wall Street, and Wall Street, I think, is skeptical here, given that that's where it trades, trading at this teens multiple, given the fact that, wait a second, like, does that make sense? And it does raise some questions of, like, is this business more cyclical than what's sort of being priced in, and we're at that part of the cycle where everything's working well? and margins are expanding. Is that the concern? Is the concern that you might have some sort of the chipset slowdown potentially? Is that what Wall Street's potentially pricing in? This is a tough one. Like I don't have good answers for this, because this, at its base, looking at this, when you see a company growing, let's say 30% and trading at a low teens multiple, it makes me think that either Wall Street's, being pessimistic about this, saying something's going to happen in the coming 6 months to 12 months, maybe even 24 months. Maybe it's a China geopolitical relationship. Maybe it's tied to the cyclicality of the business. Maybe it just grew too fast in fiscal 21, and it's going to start slowing down immediately in the quarters ahead. So far, I don't think you're really seeing that from management's commentary. It looks like, hey, we've got so many different coals in the fire. We got Internet of Things, we got automotive, the chipset, the 5G technology. The rollout's going really well. So I'm looking at this and I'm challenged by this. This is one of those that's like, wow, this is kind of tough. The licensing aspect, that's always going to be challenging for me personally, just because it's like you might have to sue your customer to make sure you get paid. But the chipset business, QCT, I'm looking at this and I'm thinking, is this a cyclical aspect where Wall Street's concerned that, hey, we're in the prime part of the cycle. I just did a video on NVIDIA earlier this week where they're posting really strong growth, incredible profit margins. So is everyone looking at this saying, hey, this is prime time? And the reality is these are cyclical businesses. So you might see a slowdown. You might see a downturn in revenue. You might see margin compression. I'd argue that's potentially what's being priced in, because trading at a teens valuation, a 2% dividend yield with this type of growth like this doesn't make sense unless you're fearful of that situation. I, at this point, don't have a strong enough opinion about the cyclicality. Will, let's say, there be a pullback with, mobile chipsets, being sold because, people are saying, hey, I just refreshed my phone post-COVID. I don't need to get a new one. I got my fancy Android. I don't need to get this new thing. So that's the question of, maybe that's the cyclical question that'll be played out. But I'd also combat that with, like, does that make sense when Internet of Things, automotive, that's more of a secular tailwind, whereas mobile, that's going to be a little bit more cyclical? This is a tough one. This strikes me as super interesting, though. You got the free cash flow, very solid business model. Looks like long-term structural tailwinds. I mean, clearly management didn't even expect to grow this quickly as well. I mean, I called out their guidance, how they were talking about mid-teens, and they're posting 30% plus growth. So clearly management, doesn't have as good of a picture of saying, hey, this is exactly what we're going to do. And I think that reflects the uncertainty of what they're tapping into and how hot the cycle can be at this point, and the question of how cold can it be in the future. If you have some thoughts about Qualcomm, I'd definitely love to hear it. I think this is the type of setup where you want to be hunting, because you see that free cash flow, you see that dividend yield, you see the fact that for its growth, it's trading at arguably a very interesting multiple. So then the question is, where does the underlying fundamentals go to from here? And that's a little bit tougher for me to answer, but I totally welcome your feedback, your thoughts. If this video has been helpful for you, provoked some questions, please make a point of hitting that thumbs up, hit that subscribe button, and thanks so much for tuning in.